You bring me this title, asking if artificial intelligence will eliminate the working class, and I look at you and I see the same look in your eyes that I saw in the eyes of the young men in the late 90s who thought the internet would eliminate the need for brick-and-mortar stores, or the men in the 20s who thought the radio would eliminate the need for reading. It is absolute nonsense. It is hogwash. But worse than that, it is dangerous hogwash because it is costing you money. We are sitting here in the year 2025, and I am looking at the valuations of these technology companies that promise to replace human cognition with a silicon chip. It is the most egregious display of mass delusion I have ever witnessed, and I have lived through the Great Depression, the Nifty 50, and the mania of the housing bubble. This idea that you can eliminate the working class is not just morally bankrupt, it is mathematically impossible within the laws of capitalism. If you eliminate the worker, you eliminate the consumer. If you eliminate the consumer, who exactly is going to buy the subscription services these overvalued software companies are selling? It is a circular logic that only makes sense to a venture capitalist trying to dump his shares on a retail investor before the music stops. Let us look at the absurdity of the current situation. You have companies today, massive technology giants, trading at multiples of earnings that imply they will capture not just all the profits in their sector, but all the profits in the entire global economy. They are pricing in a future where artificial intelligence solves every problem, cures every disease, and writes every symphony. It is the Lollapalooza effect in full swing. You have the psychological bias of simple denial, mixed with extreme social proof, mixed with the tendency to overweigh recent events. Everyone sees their neighbor getting rich on these AI stocks, so they assume the fundamental reality has changed. It has not changed. The laws of thermodynamics and the laws of economics have not been repealed just because someone built a chatbot that can write a mediocre poem. I call this rat poison squared. Why? Because it is seductive. It promises a world of leisure where machines do the work and humans reap the rewards. But look at the capital expenditure. Look at the money being poured into data centers and energy grids. These companies are spending hundreds of billions of dollars in capital expenditures in a single year. To justify that level of spending, the return on investment needs to be astronomical. But where is the cash flow? Show me the cash on the barrelhead. It is not there. The revenue is growing, yes, but the costs are growing faster. They are selling dollar bills for 90 cents and hoping to make it up on volume. It is insanity. You have prominent CEOs going on television telling you that in 5 years, software will do all the engineering. They tell you that the cost of intelligence will drop to zero. If the cost of intelligence drops to zero, then the value of the software built on that intelligence also trends toward zero. It is a race to the bottom, a commodity trap masquerading as a revolution. In the textile industry, when automation made weaving cheaper, the price of clothes went down. The weavers did not disappear, they moved to higher value tasks, and the owners of the textile mills did not become trillionaires forever because competition eroded their margins. This is basic microeconomics, a subject that seems to have been removed from the curriculum at Harvard Business School in favor of classes on how to hype a stock price. The absurdity is compounded when you look at the energy requirements. We are building these massive digital brains that consume more electricity than entire nations, all to generate marketing copy and cat videos. It is a misallocation of capital on a scale that makes the building of the pyramids look efficient. The grid cannot support it. The physics do not support it. But the market does not care about physics right now. The market cares about the narrative. The narrative is that the working class is obsolete. Let me tell you something about the working class. The working class is the engine of civilization. You cannot replace the judgment, the nuance, and the adaptability of a human being with a probabilistic model that is essentially a glorified autocomplete function. I have seen these AI models. They hallucinate. They lie. They lack a moral compass. Would you trust a machine with your life savings? Would you trust it to raise your children? Of course not. So why are we pricing these companies as if they are gods? It is the fear of missing out, plain and simple. It is envy. You see someone making money in something you do not understand, and it drives you crazy. So you buy into the story. You start believing that this time is different. You start believing that the old metrics, price to earnings, price to book, return on invested capital, do not apply. You think you have found a new paradigm. But there are no new paradigms in finance. There is only value, and there is price. And right now, the price of this AI revolution is so far above its intrinsic value that it gives me vertigo just looking at the charts. We are witnessing a transfer of wealth from the patient to the speculative, from the rational to the delusional. The idea that AI will eliminate work is a marketing slogan designed to justify valuations that have no tether to reality. It is a story told by idiots, full of sound and fury, signifying nothing but a future crash. You need to invert the problem. Instead of asking how much money can I make on AI, ask yourself how much money will I lose when the market realizes that robots cannot buy houses, cannot eat food, and cannot pay taxes? The economy is a cycle. You break the cycle, you break the system. And betting on the destruction of the system is a fool's wager. History does not repeat itself, but it rhymes. And right now, the market is rhyming with a level of stupidity I have not heard since 1999. You look at these artificial intelligence companies today, and you are not looking at innovation, you are looking at the Radio Corporation of America in 1929. You are looking at Cisco Systems in 2000. You are looking at the Nifty 50 in 1972. It is the same script, played by different actors, with better special effects, but the ending is always the tragic same. Let us go back to the 1920s. The radio was going to change everything. And it did. It changed communication, it changed entertainment, it changed politics. But if you bought RCA at the peak of the mania, you did not break even until the 1950s. Think about that. You waited a quarter of a century just to get your money back. Why? Because the technology was real, but the price was wrong. The expectation was that the radio would turn every ounce of lead into gold. It did not. It became a utility. It became a competitive business with thin margins. The same thing happened with the automobile. There were 2,000 car companies in America at the start of the 20th century. How many survived? 3. And they went bankrupt a few times along the way too. Now look at the internet bubble. I remember it vividly. We sat there at Berkshire Hathaway, Warren and I, and people called us senile. They said we did not understand the new economy. They said that clicks were more important than earnings. They said that growth was the only metric that mattered. Companies added .com to their name and their stock doubled overnight. It was mass hysteria. And what happened? The internet did change the world. It was a revolution. But the investors lost trillions. Pets.com went to zero. Even the winners, the Amazons and the Microsofts, saw their stock prices cut in half, or worse. Cisco, the pick and shovel play of the internet, the company that made the plumbing, reached a valuation that implied it would grow faster than the US economy forever. It crashed. It took 20 years to recover. Today, you have the AI picks and shovels. You have the chip manufacturers and the cloud providers. They are the Cisco of this generation. People say, but Charlie, they have real earnings. Yes, they have earnings now. But those earnings are cyclical. They are based on a massive build-out phase. Everyone is buying the chips because they are afraid of being left behind. It is panic buying. It is hoarding. But eventually, the data centers get built. Eventually, the training models reach a point of diminishing returns. And when the demand slows down, even a little bit, the multiple collapses. We saw this with the Nifty 50 in the 70s. These were the one-decision stocks. Xerox, IBM, Polaroid, Kodak. You just bought them and held them forever. They were blue-chip giants. They dominated their industries. They were invincible. Until they weren't. They were trading at 50, 60, 80 times earnings. The math simply did not work. When the bear market came, these stocks were decimated. Not because the companies were bad, IBM is still here, but because the valuations were hallucinations. You paid a price for perfection, and reality is never perfect. The pattern is always the human greed cycle. It starts with a displacement, a new technology or opportunity. Then comes the boom, where the smart money gets in. Then comes the euphoria, where the taxi driver and the shoeshine boy start giving you stock tips. That is where we are now. When my barber asks me about large language models, I know it is time to be very, very afraid. Then comes the profit-taking, and finally, the panic. We are in the late stages of euphoria. We are in the stage where skeptics are mocked and rationality is treated as treason. You have to understand the distinction between a transformational technology and a good investment. They are rarely the same thing. The railroads transformed America in the 19th century. They connected the coasts, they enabled commerce, they built the nation. But almost every railroad bondholder went broke. The competition was fierce, the capital requirements were massive, and the fraud was rampant. The canals were the same. The airlines were the same. The Wright brothers invented flight, but if you had been a capitalist at Kitty Hawk, you should have shot down the plane to save your descendants from losing money in airline stocks for the next 100 years. Artificial intelligence is the new railroad. It requires massive infrastructure. It requires endless capital. And the competition is going to be brutal. Open source models are already nipping at the heels of the giants. The moats these companies claim to have are shallow and filled with mud. Google, Microsoft, Meta, they are all spending billions to fight a war where the prize is a commodity. Intelligence is becoming a commodity. And you never pay a premium for a commodity. The investors today are ignoring the base rates. They are ignoring the fact that corporate profits as a percentage of GDP cannot stay at record highs forever. They are ignoring the fact that trees do not grow to the sky. They look at a chart that goes up and to the right and they extrapolate it to infinity. That is not analysis, that is wishful thinking. That is waiting for Santa Claus. I do not believe in Santa Claus. I believe in arithmetic. And the arithmetic of history says that every single time the market has gone parabolic like this, it has ended in tears. You think this time is different? This time is different are the 4 most expensive words in the English language. It is never different. The technology changes, the dress code changes, the jargon changes. But the behavior? The behavior is stuck in the Stone Age. It is fear and greed, oscillating back and forth. Right now, the pendulum has swung so far toward greed that it is about to break the clock. You are buying into a historical anomaly. You are betting against the mean. And the mean always wins. The mean is gravity. You can defy it for a while with enough rocket fuel, but eventually, the fuel runs out, and you come crashing back to Earth. The lesson of history is that the pioneer usually gets the arrows in his back. The first movers often go bankrupt. The hype cycle creates a graveyard of capital. Do not be the person holding the bag when the history books turn the page. Do not be the person who bought RCA in 1929. Be the person who sat on their hands, kept their powder dry, and bought the best companies in the world when they were lying in the gutter, on sale for pennies on the dollar. That is how you get rich. Not by chasing the shiny object, but by studying the past and realizing that the crowd is almost always wrong at the extremes. I have always said that if you have to use a computer to calculate the risk of an investment, you should not make the investment. The best investments are the ones where the math hits you over the head like a 2x4. It should be obvious. But when I look at the valuations of these artificial intelligence darlings in 2025, the math does not hit me over the head, it makes me want to throw up. It is not investment analysis, it is creative writing. It is fantasy. Let us do some simple arithmetic. I call it napkin math. You do not need a spreadsheet, and you certainly do not need an AI algorithm to figure this out. You just need high school algebra and a little bit of common sense, which is surprisingly uncommon. Take one of these tech giants. Let us say it is trading at a market capitalization of $4 trillion. $4 trillion. Do you know how much money that is? It is the GDP of Germany. Now, to justify holding a stock, you generally want an earnings yield that beats the risk-free rate. If I can get 5% on a US Treasury bond with zero risk, I need at least 10% from a risky equity to make it worth my while. That is the opportunity cost. So, a $4 trillion company needs to generate $400 billion in net income, cash in the pocket, every single year, just to give me a fair return. $400 billion. Currently, the most profitable companies in the history of the world are struggling to make a fraction of that. And yet, the market is pricing these companies as if they will not only reach that number but double it. To get to that level of profitability, they would have to capture a percentage of global GDP that is unprecedented. They would have to tax every transaction, every thought, every keystroke on the planet. It implies that there is no competition. But capitalism is all about competition. As soon as a company makes huge margins, competitors come in like sharks smelling blood. Margins always revert to the mean. To assume otherwise is to assume that the laws of capitalism have been suspended. Now, look at the price-to-earnings ratios. We are seeing PE ratios of 50, 70, even 100 on these AI stocks. A PE of 100 means that at current earnings, it will take 100 years for the company to earn back the money you paid for the stock. 100 years. Are you going to live that long? I am 101 years old, and let me tell you, the long term comes faster than you think, but waiting a century for a payback is ridiculous. When you buy a stock at 50 times earnings, you are implicitly saying that earnings will grow at 20 or 30% for the next decade. Do you know how hard it is to grow at 30% when you are already a behemoth? It is the law of large numbers. An elephant cannot jump like a flea. When you are small, doubling your size is easy. When you are the size of the entire IT sector, doubling your size requires finding a new planet to sell software to. And then there is the dirty little secret of AI, capital expenditure. Or as I like to call it, the money you have to spend just to stay in the same place. These companies are spending hundreds of billions on GPUs, data centers, and cooling systems. These are depreciating assets. A state-of-the-art AI chip today is scrap metal in 3 years. That means the depreciation costs are going to be massive. Accounting rules allow companies to play games with this, focusing on EBITDA, which I have always said stands for earnings before I tricked the dumb auditor. But real economic earnings must account for the fact that you have to replace all that expensive hardware constantly. If your CapEx equals your operating cash flow, you are not making money, you are running on a treadmill. You are running faster and faster just to stay still. The free cash flow that Wall Street loves to talk about is not free if it is all earmarked for the next generation of processors. Let me quote Scott McNealy from Sun Microsystems. During the dot-com bubble, his stock was trading at 10 times sales. Not earnings, sales. He told investors later, at 10 times revenues, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes that with zero R&D for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at $64? Do you realize how ridiculous those basic assumptions are? That is exactly where we are today. We have companies trading at 10, 15, 20 times sales. It is mathematically impossible for them to generate a return for the investor at these prices unless they find a way to violate the laws of physics and economics simultaneously. The bulls will argue, but Charlie, AI will increase productivity. It will create trillions in value. Maybe it will. But who captures that value? In a competitive market, productivity gains are passed on to the consumer in the form of lower prices. That is deflation. If AI makes coding cheaper, the price of software goes down. If AI makes writing cheaper, the price of content goes down. If the price of your product goes down, your revenue does not necessarily go up. It might go down. This is the great paradox. AI might be a boon for civilization, effectively lowering the cost of living for everyone, while simultaneously being a disaster for the companies selling it, because their margins will be competed away. You can have a revolutionary technology and a terrible investment. The two are not mutually exclusive. In fact, they often go hand in hand. The math of impossible returns is staring you in the face. You are paying a premium for growth that cannot physically occur, for margins that cannot be sustained, and for a future that is far more competitive than the PowerPoint presentations suggest. You are buying a lottery ticket where the jackpot is breaking even. I prefer the sure thing. I prefer the business that spits out cash, requires little capital to run, and has a price that assumes everything will go wrong. That is the margin of safety. What we have here is a margin of peril. You are standing on a bridge made of balsa wood, holding a heavy bag of gold, and arguing that gravity is just a theory. The math will win. It always wins. And when it does, the correction will be swift, brutal, and entirely predictable to anyone who bothered to use a calculator. If the mathematics of this situation are so obviously broken, why is the entire world rushing toward the cliff edge like a herd of lemmings? The answer lies not in the balance sheets, but in the primitive circuitry of the human brain. We are not rational calculating machines, we are hairless apes who learned to survive on the savannah by copying what the other apes were doing. And right now, the alpha apes are buying AI stocks, so the rest of the troop follows, terrified of being left behind to starve. We are witnessing a textbook example of what I call the psychology of human misjudgment. It is a Lollapalooza effect, a convergence of multiple psychological biases acting in the same direction to produce a result that is totally insane. The most powerful force at play here is social proof. When you see everyone around you doing something, your brain shuts down its critical thinking center and assumes the crowd must be right. You see the pension funds, the hedge funds, and your brother-in-law all piling into these trades. You think, they can't all be wrong. Let me tell you something, the crowd is frequently wrong. The crowd was wrong in the tulip mania, the crowd was wrong in the South Sea bubble, and the crowd is wrong now. In fact, the crowd is most wrong precisely when it is most convinced it is right. Then you have envy. I have always said that envy is the stupidest of the deadly sins because it is the only one you don't have any fun doing. Gluttony is fun, lust is fun, but envy is just pure pain. And nothing drives a man to financial ruin faster than seeing his neighbor, who he knows is dumber than he is, getting rich. You look at these people making 50% returns in a month on some obscure AI coin or a tech startup with no revenue, and it gnaws at you. It overrides your prudence. You stop caring about the return on your capital and start worrying about the return of your ego. You buy not because you think it is a good value, but because you cannot stand the thought of missing the party. This leads us to incentive-caused bias. Whose bread I eat, his song I sing. You have to look at the incentives of the people pushing this narrative. The Wall Street analysts, the venture capitalists, the fund managers, they are all paid to keep the game going. An analyst does not get a bonus for telling you to sit on cash. A fund manager gets fired if he underperforms the S&P 500 for 2 quarters because he didn't own the Magnificent Seven or whatever silly name they have for the bubble stocks today. These institutional investors are not buying because they believe in the long-term cash flows, they are buying because of career risk. It is better for them to fail conventionally with the crowd than to succeed unconventionally alone. They are hugging the index to protect their fees, not your wealth. They are sheep in expensive suits. We also see massive denial. The human mind has an amazing capacity to filter out information that contradicts its cherished beliefs. You show an AI bull the declining user retention rates, the sky-high energy costs, or the copyright lawsuits, and they literally do not see it. They rationalize it away. Oh, that's just a speed bump, they say. The government will bail them out, they say. It is psychological armor. When you have committed your money and your public reputation to a thesis, you will twist logic into pretzels to avoid admitting you were a fool. And let us not forget Pavlovian association. For the last 15 years, every time investors bought the dip in big tech, they were rewarded with a treat. The bell rang, they bought, and the stock went up. The brain has been hardwired to believe that tech stocks only go up. It is a conditioned reflex. But markets are not a Skinner box. The rules change. Just because buying the dip worked in 2015 and 2020 does not mean it will work in 2026 when the valuations are detached from reality. You are like the turkey who thinks the farmer is his best friend because he feeds him every day, until Thanksgiving morning. The past reinforcement is actually a trap. There is also the authority bias. You see these CEOs, figures like Sam Altman or Elon Musk, and they are treated like modern-day prophets. They speak with such confidence. They use big words. They promise utopia. The brain wants to follow a strong leader. But you must remember, these men are salesmen. They are the promoters. It is their job to hype their book. Asking a tech CEO if AI is overhyped is like asking a barber if you need a haircut. Of course they say yes. To blindly follow authority without checking the facts is an abdication of your duty as a thinking human being. The smart money is a myth. I have known many of the people who run these big institutions. They are high IQ people, yes, but they are subject to the same emotional storms as the day trader in his basement. In fact, it is often worse because they are in an echo chamber. They all go to the same conferences, read the same reports, and eat at the same restaurants. It is a feedback loop of validation. They convince each other that the emperor is wearing the most beautiful robes, while the naked truth is staring them in the face. This psychological trap is dangerous because it feels good. It feels safe to be with the herd. It feels exciting to chase the momentum. It feels validating to agree with the experts. But successful investing requires the ability to be uncomfortable. You have to be willing to look like an idiot in the short term to be a genius in the long term. You have to be willing to stand alone. The market is a mechanism for transferring wealth from the impatient to the patient, and from the emotional to the rational. Right now, the emotions are running the asylum. We are in a state of mass hysteria where skepticism is viewed as cynicism and caution is viewed as cowardice. But I tell you, the hangover from this party is going to be legendary. When the psychology shifts, and it always shifts, from greed to fear, all those biases that drove the price up will work in reverse to drive it down. The social proof will turn into a stampede for the exits. The denial will turn into despair. The envy will turn into regret. You must inoculate yourself against this madness. You must recognize these biases in your own mind. When you feel that urge to buy because the price is going up, recognize it as a biological defect, not an investment insight. Step back. Breath. Look at the numbers again. If the numbers don't make sense, no amount of psychological comfort should induce you to part with your money. The market does not care about your feelings. It does not care about your FOMO. It is a weighing machine, and eventually, the weight of reality will crush the levitation of hope. Jacobi, the great mathematician, had a simple instruction for solving difficult problems: invert, always invert. Many problems that are impossible to solve forward are easy to solve backward. So, instead of asking how can I make a fortune betting on artificial intelligence, let us invert the question. Let us ask, how can I ensure that I suffer a permanent loss of capital and ruin my financial independence? The answer to the inverted question is easy. You buy an asset with no margin of safety, at the peak of a hype cycle, based on projections that require everything to go perfectly for the next decade, while ignoring safer, guaranteed alternatives. If you want to go broke, buy the future at any price. If you want to get rich, you have to be smarter than that. You have to look at what can go wrong, not just what can go right. Let's apply inversion to this AI thesis. The bulls say, AI will change the world. Okay, assume they are right. Now, look at the downside. What if the government steps in with antitrust regulation? We are already seeing the rumblings in Europe and the US. What if the energy constraints are real, and these companies cannot build the data centers they need because the grid cannot handle it? What if the moats turn out to be illusions, and the price of AI services collapses to zero because of open-source competition? In that scenario, these stocks trading at 50 times earnings do not just go down a little bit, they get slaughtered. They go down 80, 90%. We saw it with Amazon in 2000. It fell 93%. Can you handle a 93% drawdown? Most people sell at the bottom. That is how you destroy wealth. Now, let us talk about the most important concept in all of economics: opportunity cost. Everything in life is a trade-off. When you put $1 into an overpriced tech stock, you are not just making a bet, you are choosing not to put that dollar somewhere else. You are forsaking all other opportunities. In the current environment, 2025, you have something we did not have for a long time: a risk-free return. You can go out and buy short-term U.S. Treasury bills and get, let's say, 4 or 5%, depending on the Fed's current mood. That is a hurdle rate. That is the bar you have to jump over. If you take on risk, and buying an AI stock is massive risk, you should demand a return significantly higher than the risk-free rate. If the Treasury pays 5%, I want at least 15% from a stock to justify the headache and the risk of loss. But what is the implied return of these AI stocks at these valuations? If you invert the P/E ratio, you get the earnings yield. A stock with a P/E of 100 has an earnings yield of 1%. So, let me get this straight: you are willing to take on equity risk, volatility, regulatory risk, and execution risk for a 1% yield, when you could sit on your rear end and get 5% from the government? That is not investing, that is charity. You are donating your capital to the sellers of those shares. Think about the alternatives you are ignoring. You could pay off your mortgage. That is a guaranteed, tax-free return equal to your interest rate. You could buy a local business, a car wash, a laundromat, or rental property, where you can see the cash flow, touch the assets, and understand the competition. You could buy a farm. I love farms. We own farms at Berkshire. The technology of corn has not changed much, but people still need to eat. A farm has intrinsic value. It produces a commodity that is essential. An AI chatbot that writes bad haikus is not essential. There is also the option of holding cash. People say cash is trash. I say cash is an option on future chaos. Cash gives you the ability to act when everyone else is panicking. When the AI bubble bursts, and prices will collapse. Suddenly, great businesses will be on sale. If you are fully invested in the hype now, you will be the one selling at the low to meet margin calls. If you hold cash, you will be the one buying from the distressed sellers. Cash is not just a piece of paper, it is independence. It is the ammunition you keep dry until you see the whites of their eyes. Inverting the situation also forces you to look at your circle of competence. Do you really understand how a large language model works? Do you understand the semiconductor supply chain? Do you understand the intricate details of cloud computing margins? I certainly don't, and I am fairly bright. Warren doesn't either. So we don't play. We don't invest in things we don't understand. It is that simple. There are thousands of public companies. You only need to find a few that you understand and that are priced right. Why try to jump over a 7-foot bar in the high-tech sector when you can step over a 1-foot bar in insurance, or energy, or consumer goods? The AI narrative relies on complexity. It relies on you feeling stupid, so you hand your money to the experts. Inversion relies on simplicity. It asks, does this make sense on a napkin? If the answer is no, you pass. You put the paperwork in the too hard pile and you move on. The cost of this speculation is not just the money you might lose. It is the time you lose. It is the compounding you interrupt. Compounding is the eighth wonder of the world, but it is easily broken. If you lose 50% of your portfolio, you need a 100% gain just to get back to even. That could take a decade. By chasing the quick buck in AI, you are jeopardizing the slow fortune that is virtually guaranteed if you just buy sensible assets at sensible prices and sit on them. So, when you feel the urge to buy the latest AI darling, invert the logic. Imagine it is 5 years from now and the stock has collapsed. Write down the pre-mortem. Why did it fail? Was the valuation too high? Was the competition too fierce? Was the technology overhyped? You will find that the reasons for failure are obvious right now, if you only choose to look at them. Do not let the bright light of the future blind you to the cliff you are standing on today. The smart investor looks at opportunity cost and says, I will not swing at a bad pitch. I will wait. I will hold my T-bills. I will hold my value stocks. And I will let the rest of the world go crazy. Because in the end, patience and rationality always beat frantic speculation. We have walked through the valley of the shadow of debt. We have looked at the history of financial insanity, we have done the napkin math that proves these valuations are impossible, and we have dissected the psychological defects that make smart people do stupid things. Now, we arrive at the verdict. You asked me if artificial intelligence will eliminate the working class. My answer is no. But the current hysteria surrounding artificial intelligence will absolutely eliminate the wealth of the speculating class. The working class, the plumbers, the nurses, the electricians, the teachers who actually care about their students, they will be fine. Technology changes tools, it does not eliminate the need for human effort. The washing machine did not eliminate the need for clean clothes, it just changed how we got them. AI is a tool. It is a very fancy screwdriver. But a screwdriver cannot build a house by itself, and a large language model cannot build a life. The danger is not that robots will take your job. The danger is that you will lose your life savings betting on the robots, and then you will have to work until you are 100 years old just to survive. That is the real tragedy. You are worried about the wrong risk. You are worried about obsolescence when you should be worried about insolvency. So, here's my advice to you. It is simple, it is boring, and it will make you rich if you have the temperament to follow it. First, get off the casino floor. If you own these high-flying, overhyped AI stocks that are trading at 80 times earnings, sell them. I do not care if they go up another 10% next week. I do not care if your neighbor calls you an idiot. Take the money off the table. You have been given a gift by the market, a price that is far higher than the value. Take the gift and run. Do not push your luck. In the history of financial markets, the exit door is always narrow, and when the fire starts, you will not be able to get out. Second, sit on your ass. This is the hardest thing for investors to do. They feel the need to be active, to do something. But the big money is not in the buying and the selling, but in the waiting. Cash is a position. T-bills are a position. There is no law that says you have to be fully invested in equities at the peak of a bubble. Hold your cash. Let it earn a safe return. Wait for the inevitable correction. It will come. It always comes. And when it does, you will be the only one with the liquidity to buy great businesses at fair prices. You want to be the fireman who has the water when the house is burning, not the arsonist who started the fire. Third, invest in what does not change. Jeff Bezos once said that people always ask him what is going to change in the next 10 years, but the more important question is what is not going to change. In 10 years, people will still want affordable housing. They will still want to eat good food. They will still want to be healthy. They will still want to be entertained by human stories. Invest in businesses that serve these fundamental human needs. Invest in the boring stuff. Railroads, energy, insurance, consumer staples. These businesses do not need a technological miracle to survive. They just need competent management and a fair price. Fourth, widen your own moat. The best hedge against AI is to be a human being that other human beings want to deal with. Develop your judgment. Develop your integrity. Develop your ability to understand people. Machines can process data, but they cannot understand context. They cannot display empathy. They cannot build trust. Trust is the currency of the future. If you are trustworthy, reliable, and rational, you will always have work. The circle of competence applies to your career as well. Stay within what you know, master it deeply, and do not try to compete with a computer on speed. Compete on nuance. Fifth, avoid stupidity. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. The market is full of people trying to be brilliant. They are trying to time the top, trying to pick the next Nvidia, trying to use leverage to amplify their returns. That is trying to be brilliant. It usually leads to disaster. Not stupid means avoiding leverage. It means avoiding businesses you do not understand. It means avoiding moral hazards. It means acknowledging that you do not know the future. If you can just avoid the major potholes, the road to wealth is actually quite smooth. Finally, stop looking for a savior. AI is not going to save the economy, and it is not going to save your portfolio. You have to save yourself. You have to cultivate the discipline to say no. Warren and I have said no to almost everything for decades. We have a too hard pile on our desk, and 99% of opportunities go in there. This AI craze? It goes in the too hard pile. We do not know who the winner will be, so we do not bet. We are perfectly happy missing the party. We have our cherry Coke, we have our C's candies, and we have our peace of mind. The world is full of foolish gamblers, and they will not do as well as the patient investor. The working class will survive because work is dignity, and work is necessity. But the gambling class is about to learn a very painful lesson in mean reversion. Go to bed a little wiser than you woke up. Read a book instead of watching a stock ticker. Understand the power of compound interest. And for God's sake, stay away from things that are popular, expensive, and difficult to understand. That is the Munger way. It has worked for 100 years, and I promise you, it will work for 100 more. Now, turn off the computer and go do something productive.